Good afternoon, ladies and gentlemen. My name is Michalis, and I'm the market analyst here at HF Markets. And I'd like to welcome everybody to the first webinar of this week. Most of you probably know me. I've been in the market a long time. I've been in the market for 10 years, a financial advisor, market analyst. I've worked with very large institutions. Today, we're here together to look at a session, a webinar, which is going to last approximately 55 minutes. We're going to start off with the very basics and start to build into more advanced aspects of the market. But today we're looking at news trading. Now, of course, over the past approximately 2 months, we've had a lot of webinars which are based on trading strategies. So actually how to pinpoint where to enter, where to exit, where to potentially put pending orders and your stop loss and take profits and trailing orders and so on and so forth. So we've had a lot of webinars based on this. Now, today we're looking at news. The reason why we're looking at news is because this is something which has been on numerous occasions requested by viewers on our webinars. Now, this doesn't mean, ladies and gentlemen, that we need to disregard the strategies that we've looked at over the past few weeks, because over the past few weeks, we've looked at many strategies, including the sentiment cross strategy. We've looked at least 5 different types of scalping strategies. We've looked at mean reversion strategies together as well. It doesn't mean that we're going to disregard these because we're now looking at trading news. It is still something which is applicable, but today we're going to look at what other aspects of the market we need to look at, how we need to amend strategies, and also look at specific methods and approaches which are solely related to news. So in a sense, we're not ignoring the strategies that we've looked at previously, but we're looking at how to enhance our trading. We're looking at expanding our knowledge and experience and expertise, and more specifically aspects of the financial trader market, which is related to trading the news. Because we've had at least 20 requests over the past months. Or the past month, sorry. So within the month of April, we had approximately 23 requests within regards to the topic itself. And just so everybody's aware, if you do have any specific topics, if there's something that you as an individual, whether you're an experienced or an individual that has never traded before, if you've got this specific aspect of the market which you personally are finding difficult, these sessions, yes, we either are looking at presentations, sometimes we have live analysis webinars as well. Either way, it's not a lecture. It's not just to sit down, write notes, have your pen and paper there. There is options to ask questions, and throughout our webinars we get a lot of questions. So you will see on the GoToWebinar software there is a section which is questions. You can write your question, send it to me. I will automatically, instantly get it. I'll read the question out. Of course, I won't expose any sensitive personal information about yourself, such as your name, but I'll read the question and we'll answer the question together as a team. Now, before we start looking at news and aspects of news trading and also strategies specifically related to that, before we start looking at that, we will have 2 slides. Very quick, I want to go through these slides as quickly as possible so we can start looking at these topics. But of course, these slides are important as well. Now, a lot of people know me as a financial advisor because I originally started off in London as a financial advisor. But these sessions are not here to give you direct financial advice. These sessions here are for educational purposes. If somebody wants independent financial advice, then of course they can seek that. There's a lot of individuals available out there. But these webinars, they're here for educational purposes. So yes, we don't want to give, as part of today's session, investment advice and financial advice, but what we do want to do is give you as much educational material as possible in order for you to 100% be able to be active in the financial trading market with knowledge, with experience, with expertise, and with confidence. This is what we're aiming to do. And of course, aspects of what we're going to be looking at as part of today's session is of course something that you can straight away today use as part of your trading if that's something you wish to do. The last thing I'll mention as part of this slide is, of course, here at HF Markets, we are dealing with webinars. We're dealing with investments. And with all investments, of course, we provide the platform, we provide the service, we provide a lot of educational materials such as webinars, but we have no control over how stocks move, such as Apple stocks, Tesla stocks. This is all centralized, okay? So it's in no way, shape or form controlled by us as a platform. So we have no control over the price of these assets. We have no control over your investment. You are free to invest as and when you wish. And of course, you have to understand there's a level of risk to that because it's an investment, as there is with all investments. Doesn't matter if you're investing in cryptocurrencies, invested in stocks or currencies, whatever it may be. Of course, what we do want to do is ensure that you're able to do so with knowledge, so you're in control and trading and abiding along the lines and rules which you personally set out. Because of course, everybody's got different targets, everybody has a different approach, everybody has a different risk appetite. So there's no correct way of trading, but what we want to do as part of these educational sessions is to ensure that you are trading in what is correct for you, to helping you establish what that is. Now, with this slide, this is the last slide, and we're going to go straight to the topic. With this slide, it's not important. It's not going to make you a successful trader. It's not related to today's topic, but I do get a lot of questions. People can find me on LinkedIn. If you go to the FCA website, you can find me. If you go to CISEC's website, you can find me. So both on UK and European regulators, you'll find me on the regulators' website. But a little bit of information about me as an individual, because I'm of course providing you with this information, and it is important to know a bit about the individual who's providing you with the information. So I've been in the market for 10 years. I'm a licensed financial advisor, both in the UK and in the European Union. So both by the FCA and CISEC. So in the UK, it's CMAP license. In Cyprus, where our head office is, it's CISEC Advanced license. Originally, I was a financial advisor in London. Been trading and in the market for 10 years. We do tools for all levels of traders, for beginners, for intermediates. We're one of the only brokers as well that even do advanced trading and webinars. We're one of the very few that's going to look at something like order flow analysis, delta statistics, cumulative delta, the DOM, and so on and so forth. So this is something very advanced that pretty much nobody in the financial trading market has educational sessions on. So if this is somebody's first webinar, just so you're aware, something which I do, because I like to think of traders as a team. It is us against the market. And of course, I like to share ideas, and I want everybody to be communicating with each other. At the end of each webinar, we have a poll and we discuss a specific topic. Now, we all vote on the poll, and then the next week on the first webinar, we look at what was the results of that poll. So the last poll that we did was on the 2nd of May, so that was last Thursday. The question was, will gold end the week higher? So will gold end the week higher than the current price? Now, what was the price at the time of the poll? The price at the time of the poll was 2,298. 67% of voters believed that it would end the week higher. 33% advised it will end the week lower. Now, between Thursday and Friday, we actually had a higher price and we had a lower price. So it's very important that I mention that it wasn't just a very straight upward trend. There was volatility. It wasn't like the week before where it just shot up and everybody was 100% correct in terms of the poll. Today is kind of 50-50 because we did see at times the price declined, at times the price increased. But we mainly did see an upward price movement. So the price high by the end of the week was 2,320. So that's almost 1% higher, which is a considerable amount for especially CFD traders like ourselves, which are using short-term price movements to benefit from the market. But by the end of the week, so by market close on Friday evening, it only rose and ended at 2,301, almost 2. So that's only 0.13% high. The current price, though, ladies and gentlemen, is 2,318 when I did this presentation approximately 2 hours ago. So most of the voters were correct. Yes, 67%, technically speaking, that was correct. So well done, everybody. Most of the individuals voting, the most popular answer was correct. Yes, it did end the week higher. But on this occasion, there is a but, because there's kind of a 50-50 scenario, because at times between Thursday and Friday, it did decline as well. So even this 33% that were traded in the short term could have had some beneficial trades from that as well. But technically speaking, yes, the main most popular answer was correct. Gold ended the week higher. Today, we're actually going to be looking at the Dow Jones in today's poll at the very end of the webinar. So news trading, very quick introduction. What is news trading, and why do traders, specifically CFD traders, because we have individuals that are building portfolios, we have, of course, individuals that are looking at different approaches, such as position trading approach, such as, for example, the swing trading method. But most traders within not only CFDs, but also derivatives, so people trading options, futures, and so on and so forth, these individuals, a lot of the time, specifically aim their approach to the ultra short-term methodology. Why? Because a lot of the time they're using leverage. Sometimes it can be a very high level of leverage. And because of this, they want to enter, benefit, exit, enter, benefit, exit. And so, and continue that, and ideally be able to do that consecutively, be able to do that efficiently, successfully, consecutively. Those 3 words are very key when we're trading CFDs. So why is news very popular for individuals like us? Whereas when we're looking at portfolios, yes, depending on the news, if, for example, we're looking at CPI, we're looking at the press conference of the Federal Reserve, yes, it's very important, but other pieces of news are not as important, especially in today's market, where the real driver is very simply inflation and interest rates. Everything else, including the NFP results, it's important because it's related to inflation and interest rates. So everything that's as important is everything which is going to be having a domino effect on the Federal Reserve's interest rate adjustments. So that's what is important as part of today's news, in today's environment, should we say. So individuals build a portfolio, they only really care about that. But individuals like ourselves, we even are looking at the less important news within the market. Now, trading the news. When news is released, investors quickly amend their portfolios, especially large institutions and funds. So the way that we need to think of the market, if we are going to be successful, is you have to understand that the large institutions, especially, for example, BlackRock and Goldman Sachs and these very large funds, these individuals are what's driving the market. If you're buying and selling, and even if we've got professional fund managers, when I first started within the market, we were working very closely with professional fund managers, UCITS, for example, and different types of funds. They were dealing with millions, but even individuals like these, they weren't having a real effect on the market. What's driving the market is, at the end of the day, particularly large institutions and funds. So in order for us to be able to be successful, we need to understand how they are active in the financial trading markets, especially around news developments. So as a result, of course, when we get a piece of news, what actually happens is as we're approaching that news announcement, these institutions are altering their funds in order to prepare for that. As they alter their funds and their exposures to certain assets and certain markets and certain categories, of course, this creates volatility. So that is something which traders use because it creates volatility. Where there's volatility, there's price movement for us to be trading. And then, of course, depending on what is officially released, again, it may be altered, it may be enhanced, it may be changed. It depends on what is actually released. So this is what we're going to be looking at, because when you get those alterations, we get volatility, we may get a spike, we may get a collapse, and we need to find out how to take advantage of that. But why do traders look at trading news? This is what news is, this is who's driving it, and so on. We're going to look at that, of course, in more detail. But why do traders look at trading news? First, number one, there's a lot of volatility. We'll look at examples as well, ladies and gentlemen. There's a lot of volatility. And of course, probably everybody watching today's webinar is trading with leverage as well. Some people may not be, leverage is completely in your control. Some people may want very high leverage. Some people may want no leverage or very low leverage. It's completely down to you. But most people are trading with leverage, and what most people want to see is volatility. Put it this way, if you are trading an asset which is not moving, it's impossible to trade it. A lot of people say, it's too much volatility on this asset, I can't trade it. Yes, okay, certain assets which are very volatile may be difficult to trade, but if there's no volatility at all, it's impossible to trade, okay? If there is a very little volatility, most likely people that are going to be interested in it is people that are building portfolios, in which case they may be looking at maybe volatility, which is going to happen in 2 years, 3 years. Maybe they may be looking at different income streams. So for example, it could be, just an example, it could be dividends, it could be yields, it could be other streams of income, not necessarily profiting from the price movement itself. So this is definitely something that we need to take into consideration. The other thing is we have a lot of individuals that are very interested in fundamental analysis. We had quite a lot of requests, and we will do webinars as well based on solely looking at fundamental analysis, because the strategies that we've been looking at, the swing sentiment strategy, we had a lot of scalping strategies, trend-based strategies. All of these were based on technical analysis, so analyzing the price movement, momentum, certain volume profiles, whereas we've got individuals that want to understand how they can trade based on what's developing within the market. News is, of course, allowing individuals to take that into consideration, what is being released, what information is and data is being released into the market, and how they can use that as an indication. Now, we have to be very cautious about this because fundamental analysis is, of course, mainly developed for somebody looking to build portfolios. But there is 100% ways in which we can alter it, okay, specifically related to news. We're going to look at something that very few people look at, specifically related to news, how you can look at fundamental analysis to determine how the price movement is potentially going to move after the announcement. And we're going to look at how we can measure this, because it's all about measuring it and developing that bias, painting that picture before it's actually released. So it's not looking at, for example, we had a positive event, the next month we had a positive event, so this month is going to be a positive event as well. That's purely rubbish. We've got a lot of educators, not us as a company, but as a market, there's a lot of educators on YouTube which provide educational sessions about this, and I can guarantee you nobody, especially when I was working with large institutions as a financial advisor, nobody on the trading floor looked at the market and said, we've had 3 months of positive data, we're definitely going to have a positive data this time. Or we keep having positive data, it's impossible that we're going to have consecutively that much positive data, it's going to be lower this time. Or, you know, using their emotions to speculate. Nobody in the financial trading markets uses their emotions to speculate. Emotions can be actually a very dangerous thing. So it's about measuring, okay? Measuring, very important. But we're going to look at how to do that later on. And of course, when we get news, the ability to trigger a trend. Again, especially what's been announced, if it's related or has a domino effect on interest rate, yes, it can definitely trigger trends. But what is the issue? Why do we have so many people asking for a webinar which is related to trading news? If it's, you know, we get volatility, we want volatility. We're able to use information within the market as an extra signal, perfect. It triggers trends, perfect. You know, so why do we need a webinar? Well, what's the issue? What are we finding difficult within the market? And what do we need to solve today? Solve it today as part of our session. So these are the 3 points here. Let's see if some of you guys as well have experienced this and find this difficult. Maybe you haven't experienced this. Maybe somebody has never traded the news and thinking about it for the first time. In which case, if that is the scenario, you don't have to experience these to learn from them. Make a note of them. We're going to look at examples and be prepared. So point number 1, the price does not follow the traditional response. So I'll give you a very simple example. Earnings data. We're currently in the middle of earnings season. We're actually probably past just about halfway, actually. So earnings season 4 times a year, all of these companies where the stocks are trading in the central stock exchange, whether it's the Chicago exchange, the New York, the NASDAQ exchange, whatever it may be, they will release their earnings, their accounts, which will also include their revenue and turnover, their levels of gearing, and so on and so forth. Excuse me. So these companies, let's say we've got a company, it releases its earnings. The earnings was higher than the previous quarter. It was higher than expected. It was also, the revenue was higher. The revenue was higher than expected as well, but the stocks declined. Okay, so why is the price of the stock declining? I could give you an example as well. I remember Netflix was a very good example. Very negative, very positive earnings data, but the stock declined at first. Tesla, a very good example as well. One of the worst performing stocks of this year. Also, the earnings data was very poor, both revenue and earnings per share, especially gearing levels as well, was very negative, but the stock increased in value. So people probably thinking to themselves, who may not be experienced in the market, what is going on? You know, it's impossible. How can I trade news? This is stupid. How can I trade based on this? But you can definitely 100% can. So, and I can guarantee you these funds, okay, they're investing, you know, BlackRock, Goldman Sachs, JP Morgan, Charles Schwab's, and so on and so forth. These individuals, they're investing because they're making money from this. You can also visit their earnings data and you can see that they are. So you definitely can benefit from these. We're going to look at this today as well. So this is one of the issues we need to solve. The second issue, it does follow the traditional price movement, but there's a lot of volatility in both directions. So basically, yes, maybe the news is positive. Let's get a pen out so we can show you an example, but we will look at real examples as well. Let's say we get sideways price movement because we're about to get news, so nobody's trading because they want news to be released. It's positive, it does this, great, happy days. Everybody here in this area of the market starts trading and buying. Profits getting higher, everybody's happy, and then the price does this. This is definitely an issue that we need to resolve and remedy. Next thing, the price movement is limited. A lot of the time people are expecting a lot of price movement. The news is announced, not much volatility. And again, where there's not volatility, maybe people think where there isn't volatility, it's a good thing, okay, that is safer to trade. If something's not got volatility, it's not safer to trade. It actually can be more difficult to trade. So we definitely need to take that into consideration as well. Let's look at some examples. I won't spend too much time on examples. I'm pretty sure most people here watching today's webinar have seen them before, but very quickly we'll look at some examples of all of these three issues. This is actually an example from only a few days ago. So here we've got gold. There's a 15-minute time frame. You can see the dates down here, so you can see them, visit it yourself if you wish to. So this was, of course, in response to NFP Friday. NFP Friday came in much lower. The average hourly earnings came in much lower. The unemployment rate came in higher. So everything negative, negative, negative. Most of the time that does trigger the price of gold to increase. The price of gold did increase. It increased for 45 minutes. To be honest, it's probably more than enough for short-term traders to profit and close the trade. But definitely we may have some individuals that delayed entering. We may have some individuals that wanted slightly more or wanted to trade slightly longer term. Well, whatever that may be. So we did get that traditional price movement, but what happened after that? Very, very big price movement in the opposite direction. What happened after that? Very big price movement in the opposite direction again. So we're getting up, down scenario. Some people, especially for beginners, now understand 100% because at one point I, of course, was a beginner as well. It's very difficult. This is just an example. I'm not going to spend too much time on this slide. So let's very quickly release a poll. Let's see how many individuals. I'm only going to allow 45 seconds as part of this poll. How many individuals find a correction when news trading, during news and trading the news? How many people find it difficult? So far, I've only got one person that has replied, 2 people have replied, 3 people, 4 people, 5. Okay, so there's a lot of people replying now. 10, 20 people now. Almost 30 people. Very close to 40 people now. Okay, let's end the poll. Okay, so let's close the poll. Right, let me confirm to everybody. So everybody's going to get an idea as well. 88% of people in the poll said yes, they find this difficult when trading the news. 8% said they find it really difficult. So they do find it difficult, but not always. Okay, or rarely, should we say. 4% said no, I don't find it difficult. So we can see the vast majority find there's something difficult. This is definitely something we're going to look to remedy, of course. Another example, untraditional price movement. And again, some people are probably going to say to me, you know, it's yes, it's untraditional, but there's a reason for it because it's related to interest rates. We're looking at the domino effect. Yes, I understand, of course. I'm an economist. I'm a financial advisor. I do understand why stocks rose. It's very easy to understand. But we're going to look at this just as an example. So here we've got the NASDAQ 15-minute time frame. The employment data was poor. Average hourly earnings was poor. NFP was very low. It's the lowest that it's been since October. So we're going back at 7 months ago. Unemployment rate rose. Traditionally, this is something which is negative. Okay, at the moment, yes, it is positive, but traditionally, this is something which is negative. A lot of the time, it's very popular. Sorry, not popular. It's very common, should we say, that a piece of news is released and the news indicates that the price should increase, but the price decreases. Or the news indicates the price should decrease, but the price increases. This is an example as well. Yes, there's a reason for it, but this is an example. So unemployment was high, newly added jobs was very low, and of course that's negative for the stock market for very clear, good reasons. So this is another poll. This is actually the last poll that we're going to look at for the moment. So how many individuals experience something like this, where they get a piece of news and it moves in an untraditional direction? Could be, for example, CPI. CPI comes in higher than expected, but the stock market actually increases, for example. Again, I won't allow too long. I only will allow 15 more seconds. 30 people have voted, 43, 46. Actually, let's end because most people have voted now. So let's close the poll. 92% voted that they've experienced this. 8% said they haven't experienced this. So this is something we're going to remedy as well. No reaction. Okay, so this is what we mentioned as the third issue. We won't do a poll for this. We don't have to do a poll each and every time. But this is an example. Here we had a very important index which was going to be released. This is the Euro USD 15-minute time frame again. This is going back to last Wednesday. We had a very important index released, and also we had quite a lot of news released at the same time related to the US dollar. Even though we did get that announcement, and it was different to what was expected, so normally it would create volatility. You can see there wasn't much volatility there. Wasn't much volatility at all. There's a reason for it. It's a very good reason. So we have to keep this into consideration. This is the first thing actually people should make a note of. If there's news, look at what other news is going to be released. Because if somebody's looking at this piece of news and not looking at anything else, not looking at what's going to be released later in the day, later within the week, you really need to look at what else is in there. Because if it's about to be overshadowed by something, it's not going to create volatility. So for example, here we had an index, but here, ladies and gentlemen, we had the Federal Reserve interest rate decision, and we also had the press conference of the chairman, Jerome Powell. So it's understandable that it didn't get a lot of volatility, like for example, it did here. What should we say about this? We did get upward price movement. What did we get after that? Correction. Okay, so here's another very good example as well. But the first thing I want people to make a note of before we start going more advanced, because we're about to go more advanced now. The first thing I want people to make a note of, especially if they see untraditional price movement to the market. If they see no price movement and reaction to the market, we have to look at, of course, to the fact that there may be something else that's upcoming which has drawn traders' attention. Okay, so for example, it's like if we're looking at football. Okay, so I can see there's a lot of names here of gentlemen. Not that our female traders cannot, of course, be interested in football. But if we've got, for example, two games left, and today we have, should we say, Arsenal, who's going to play, should we say, West Ham. But next week we have Arsenal, which is going to play Manchester City. Nobody's going to go today and say, I 100% believe that Arsenal will win the Premier League. Why? Because in the upcoming days, we have something which is even more important. They'll start to, should we say, bet when we get to that time. Okay, so I've got a question. I'll answer this question before looking at the two news trading strategy that we're going to take into consideration. So untraditional happened with oil price after Israel retaliation to Iran attack. Yes, it was an escalation, but we have to look at the overall picture in regards to this, because I do remember this, because it wasn't that long ago. Yes, there was a retaliation. If there is a retaliation, technically speaking, traditionally, it would cause escalation. There would be a fear of supply chain disruptions and higher demand for oil as well. But we have to look at the overall picture. So we have to look at the fact that, yes, there was a retaliation. Retaliation was weak and limited. Wasn't likely to trigger a response from Iran. There was no, should we say, significant damage or no deaths. We did get the government of Iran immediately come out and say that they weren't going to react as well. And also at the same time, within that day, there was also news released about the progress of peace talks between Gaza and other representatives as well, including the US, especially Egypt, Qatar as well. Because of that, there was, should we say, indications of de-escalation. So it may have looked untraditional, but if you look deeper, it wasn't necessarily quite untraditional. So let's carry on with this slide here. By the way, if people have more questions, feel free to ask questions throughout the session, of course. I can see another question. I'll answer it in a moment so we don't keep everybody waiting. So news trading strategies. Before we start looking at techniques, because in a moment now, we're going to start looking at techniques and indicators and how and when and at which point and so on and so forth. Before we start looking at that, it's going to fall into two categories. News trading strategies will always fall into these two strategies. So we have non-directional bias strategies and we have directional bias strategies. So non-directional, this is especially for individuals looking at technical analysis, especially scalpers. Scalpers are very well known to be non-directional bias traders, but there is other methods as well, which also look at this. There is other strategies that we've looked at recently as well, such as the sentiment the sentiment cross strategy is a strategy that we looked at last week, which is directional bias. So we've got examples for both. Now, what is non-directional bias? This is a method which normally is popular amongst technical analysts, like I said, and investors which give greater importance to trading the price. So there is individuals who they look at the news and say, yes, we have the CPI, which is about to be released, but I will not look at it. There is benefits to this to a certain extent because it doesn't cloud your mind. This is what these individuals say. I'm not going to say that one's correct and the other one's not correct. I will say what is generally known within the financial trading markets. But what these individuals say is, if I look at the announcement, it will cloud my mind and I'll start trading based on my emotions, which is something which I want to avoid, especially again, scalpers, technical analysts. This is what they want to do. So this is the why they don't look at the news. They look at the calendar, they say, right, we have the CPI, it's important, it will create a lot of volatility, that's all I need to know. So this is the time, this is when I'm going to be trading, I don't need to know anything else. I don't care if it's more, I don't care if it's less, and so on and so forth. So this is the non-directional bias. The method is that investors should not pre-analyze the market or the asset, and that is enough just to simply know that it's a vital event, that there's going to be volatility, and that is a must-trade moment within the market. Other than that, they have their indicators, they have their approach, their methodology, and they'll trade based on that. Then we have the directional bias. Directional bias is as we're approaching the announcement, and to be honest, because we've got a lot of individuals who are actually at the same time they're trading, but they're also building portfolios as well. For those individuals, because they always ask me a lot of questions as well, if you are building portfolios, we have individuals that want to build portfolios for the future 5 years, the future 2 years, and so on and so forth. you can still apply directional bias. It's not always analyzing days before the event. It could be weeks before the event. It could be months before the event as well. Especially, for example, earnings. We've got an individual. I've actually got a question here from an individual who's actually asking about stocks. So, for example, stocks earnings only come 4 times a year. So you could be preparing 3 months ahead, for example. So days before the announcement is made, the investor starts to price what is expected. This is very important. The way the market works, and people think the market works in this way, that the news is released and the market starts pricing that in. Before the news is ever released, the market, these large institutions, funds will start pricing in what they expect to happen within the market. So for example, if the NFP Friday is expected to read 200,000, then what actually happens on the day, if the actual announcement is 200,000, is that there's not much volatility, or what will actually happen is the price will decline. Why? Because it's already been priced into the market. Okay, and it may start to decline. It may start to actually decline very simply because there's something very well known in the market that you trade as the news is approaching, and then you sell and profit in, cash in your profits as soon as the news is released. So this is a good example of that as well. In the markets, investors say trade the rumor, close your profits on the news, or some people say buy the rumor, sell the news. This is exactly what I'm referring to. People, this will answer actually a lot of people's issues. Now, it's not gonna, we've mentioned that there's 3 issues: untraditional price movements, the correction, which is very upcoming and imminent after the first impulse wave, and also when we get no reaction. This isn't going to answer or help you, the fact that you now know that large institutions, they trade the rumor and then cash in on the news announcement a lot of the time. We're going to look at the remedies starting from the next slide. But this is important to understand, because by knowing this, you already understand a percentage of why we see certain types of price movements. Now, what should you be focusing on? Because I can see somebody here has already answered that, has already asked that if they should be using a non-directional bias or directional bias. Most economists, most financial advisors as well, they advise that you should use a certain level of both. Now, when you're looking at longer term price movements, when you're looking at longer term price movement, for example, individuals building portfolios, or people looking at more swing to medium term approaches or position trading, then the directional bias becomes more important. Doesn't mean though that the non-directional bias isn't important. And the same thing applies for short-term traders like CFD traders. Directional bias is important, but yes, non-directional bias is something which may take more center stage. Now we've got a couple of questions. I'll quickly answer these questions. I've actually got an individual who has left the webinar. He said he cannot hear me. I can see people are asking questions, so I'm guessing people can hear me. If somebody cannot hear me though, please leave a comment and I can double check. But from what I can see, everybody can hear. If somebody can't hear, log out and log back in. Maybe this will help. Then I've got another question here. So I've got an individual who says different news events can have an impact on the price movement. How can I weigh the impact of each event on the price, especially if they contradict each other? This is a very good question. I'll actually answer this on the next slide. I think it's the next slide. If it's not the next slide, I will answer it now. But I think it's on the next slide. Well, sometimes this is another individual. Well, sometimes you find the actual and forecast different to the news which is released. Does this mean technical analysis applies in this trend? Technical analysis will always apply. Okay, so whether it comes in as expected, if it comes in contradicting, if it comes in higher than expected or lower than expected, technical analysis will always apply. And you're going to see that on the next slide, because that's where we're going to start looking at technical analysis. Now, this is very important in regards to what this gentleman, I won't mention her name, almost did there, but this gentleman asked a question, because he says, how can I measure the impact on the price movement? How can I measure the impact of one compared to the other, contradicting news announcements, and so on and so forth. What I will say in terms of contradicting news announcements is you have to really understand the domino effect of the market. And I mentioned this here, the domino effect, the fact that when one thing happens, it will trigger something else, and then it will trigger something else, and so on and so forth. If it's something which is going to cause a domino effect on interest rates within today's financial market conditions, then it's something which is going to overshadow the other event. So if you have one event which is contradicting the other, the one which has the domino effect on interest rates will be the one that will overshadow it. Okay. Otherwise, ladies and gentlemen, most likely it will not. At the moment, like I said, the main thing is what's having a domino effect on interest rates. Now, this may not be the case in the future. In the past, for example, it wasn't the case. If, for example, at the moment we have a stock market crash, we have a recession, then of course that's not going to be the main thing which is going to be in the spotlight. Is actually going to be earnings, unemployment, and economic growth. Whereas at the moment, the only reason that may be important is because it has an effect on interest rates. So understand the domino effect, understand the current financial conditions within the market, and then you will understand how you can measure one event on versus the other, and when they're contradicting, which one holds a greater weight. So first things first, is there a reason for an asset not following its traditional path? So if I go back quite a few slides, actually, one of the points which we mentioned is the price does not follow the traditional response of the market. Okay, so we can see that here. So this is the first remedy that we're going to need to look at. Now, in order to do that, I've gone a slide too far. Before we look at this, ladies and gentlemen, let's look at this. All right, so we have to understand, like I said, that domino effect. We have to understand the financial market condition at the moment. So we have to understand really deep down what is going to influence the market. So for example, somebody mentioned to me earlier as part of today's session, because I can see some people have just entered. As part of today's session, they said to me, I expected oil to increase in value. Iran retaliated. It's the first time they retaliated in this way, directly sending missiles to Israel. Israel retaliated. When Israel retaliated, the price of oil didn't increase. The price of oil declined. So it's really about looking at the true intrinsic value of the asset and truly what is driving the market. So for example, a good example of this is the stock market and positive economic data. A lot of the time, and traditionally speaking, if we go back, 3 years, 4 years, 5 years, 6 years, all the way back decades, okay? Traditionally speaking, good, positive economic data is having a positive effect on the stock market. This has only changed in the past 18 months. Very max in the past 2 years. Why? Because, ladies and gentlemen, what we want to see at the moment is the Federal Reserve be pressured into adjusting their interest rates, okay? So every time that the unemployment rate increases, even if it's just ticking upwards, it's like you come and start pointing and start picking and pinching the Federal Reserve, okay, and saying, look, wake up, all right, because interest rates are high. Yes, you've increased them and made them high in order to lower demand, in order to lower inflation, which is your target, which is, of course, very, very important for the health of the economy and, of course, for the health of consumers. But it's now having a negative effect on the economy. We cannot allow it to have a negative effect on the economy, so decrease interest rates. If you decrease interest rates, then all of these assets, okay, which were benefiting from high interest rates, such as the bond market, such as savings, such as fixed accounts, such as other fixed period investments. When we're looking at these individuals, when we look at these assets, they benefit from high interest rates. Whereas now that they're not benefiting from them, then individuals are not interested in them. Why? Because they're not paying enough. So they cash out of those investments and they start to look at alternatives. What alternatives are they going to look at? A good alternative is, for example, the stock market. They start looking at the stock market. As they start looking at that as an alternative, the stock market increases. So you can see it's really about truly understanding what is going to drive the market. Yes, traditionally, higher economic data is positive for the stock market. At the moment, though, we want to pressure the Federal Reserve. Now, there's a very thin line. It's a silver lining, ladies and gentlemen. And yeah, I will have to mention this. If we get such bad data, or if we get consecutively bad data, then it will cause the stock market to decline anyway. Why? Because it actually causes investors to have poor sentiment, okay? Because people go, whoa, all right. So yes, we're about to get interest rates declining. This is positive for the stock market. This is what we want to see, but I'm not interested in the stock market at the moment because the economy is contracting. It's the third time now that we've got negative data. Is there going to be a recession? If there's going to be a recession, I'm not interested. I'd rather keep my money in my savings account. So there's a thin lining. We want it to be bad enough to pressure the Fed, but not bad enough to trigger this type of sentiment towards the financial trading market. I've got a question here. I'll quickly answer this question. Is it good to use buy stops, sell stops, and sell limits during news announcements? Yes, of course you can. There is benefits to it. It's not as good as we looked at this last week, okay? Because we looked at it specifically for the sentiment cross strategy, okay? There's more benefits to using it for that. Why? Because we're looking at steady volatility and there's less chances of slippage. Now, if there's a lot of volatility, there's a higher possibility of slippage when using pending orders. Doesn't mean there will be. So, of course, you can use them. Just be slightly cautious of slippage. The only time which is negative, okay, which is not good to use pending orders, is if it's actually going to cause a price gap. If it's going to cause a price gap, there's going to be a lot of slippage. But to be honest with you, even if you're using market orders, you would have opened on a new price anyway. So there would have been slippage there anyway. Slippage it's not a bad thing. It's not something untraditional, something very well known within the market. It means that nobody was willing to buy and sell at that price. So we've gone to the new price. Can I send the recording to you? Yes, of course, I can send the recording to you. What is slippage? Slippage is when the price wasn't available and it forms as a gap on the chart. I think I've got an example. I'll show you an example as part of this slide. So it's, for example, if, let's say I'm selling something. So let's say I'm selling my computer mouse, okay? Selling the computer mouse and I say, buy it for $5. And you say, no, I'll buy it for $2. And I say, no, $5. And you say $2. And I say, okay, $4. and you say no, 2. And I say, okay, 3, and you say no, 2. And then I say, okay, buy it for 2. What's actually happened is I've seen slippage. It's dropped not from 5 to 4, but it's dropped from 5 to 2. So there will be a gap there. Why? Because nobody was willing to buy it at that price. So it goes to the next available price. So of course, if you're using pending orders, there's an issue there where there's going to be a price gap. If there's going to be a price gap, it's not always a price gap. It's got to be very important news and something really unexpected for there to be a price gap. Next thing, ladies and gentlemen, what is being priced within the market, the previous release and the official release. Now, this is something very important. I want people really to look at this. We've got 3 examples here. We'll go through it, and as I go through it, you'll really start to get a good example and understanding of how I'm looking at it, and looking at it as a more professional and looking at it the way that institutions look at it. So for example, the CPI, something very important, one of the most important announcements. If it's not the most important, it's the second most important. So CPI, the previous figure was 3.5%. Got another question, I'll answer it in a moment. 3.5%. Expected was, the expectation was 3%. So it's at 3.5. What is expected is 3%. Very, very big difference, okay? What is happening today, ladies and gentlemen? It's increased by 0.10% the past 24 hours, so not just today, but also yesterday as well. 0.10% above, that's nothing. So we're here, we're looking at the market, inflation is super important, and it's about to decline by 0.5%, ladies and gentlemen. And the market is only increasing by 0.10% over the past 24 hours. The release is 2.9%. Okay, so it was better than expected, but only slightly. People may say that's only slight, it's not a big deal. It's only slightly coming lower than expected. But look at it this way. It's a very big difference to the current moment. So it's actually 0.6% lower. It's lower than expected, and the market didn't price it in. Okay, so for example, we may be looking at the stock market. Lower inflation causes the stock market to increase. The market hasn't priced it in. It's only 0.10% higher from yesterday. So that if the market hasn't priced it in, they weren't expecting it. Okay, or they weren't taking advantage of it for other reasons. You of course look at the other reasons. If there's nothing there with alarm bells, then of course what you can take into consideration is that they weren't expecting it. So here you can see a price reaction of 1.29%. That's a very big amount of volatility. So these are real examples. It's not all related to CPI, not all related to the stock market, but these are real examples that I've looked at from recent months. Then a second example, 3.5 expected to decline to 3.3, increasing already by 0.71%. So a lot of price movement comes in at 3.1. So it's positive, okay? It's more positive than the 3. So here there's a decline of just 0.1% more than expected. Here it's 0.2% more than expected. It's double. So it's much lower than expected. So people say, well, it should be declining. Sorry, it should be increasing in the stock market more than 1.29%, but it's not. It's only increasing by 0.5%. Why? Because it's already increased quite a lot. Okay, so we have to factor that into the market. The market has already priced it in. Okay. Yes, they're priced in. Keep in mind the 3.3% is coming lower, which is why it's 0.5% higher, but not much volatility because it was priced in. This is another example here. 3.5 expected to come in at 3.5, minus 0.22%, comes in at 3.4, so lower than expected, But of course, ideally, this is what people want to see. People would rather see it come in at 3.1%, actually comes in at 3.4%, but the market increases by 0.66%. So if this is better than this, why is this event here having more volatility? It's very simple, because it's not priced into the market here, and it's not priced into the market here. So as we approach the event, look at what is being priced into the market. In addition to what was released last month, what is expected this month. So when I say last month, I mean what is the current statistic for inflation, the current data, what is expected for this month, and what is being priced within the market, okay? And then you will really start to understand the reaction here. So hopefully that made sense, because it's slightly more advanced. Let me quickly answer the question, and then we'll start looking at technical analysis. So does the NFP determine what might happen during the CPI in the market? Yes, it does, but you cannot see a direct and imminent a direct and imminent effect on CPI. Okay, so what do I mean by that? The employment rate may increase, so there's more unemployed individuals this month. Doesn't mean inflation next month is going to come in lower. It may decrease for 2 months. Doesn't mean after that it's going to come in lower. But in the longer term, yes, it will cause inflation to decline. Okay, so avoid trying to look at it as having an imminent effect on the market, because a lot of the time it doesn't. But without a doubt, it does have an effect. So let's start looking at our charts. So here we've got gold. We've got a 2-hour chart, very, very important chart, ladies and gentlemen. What we need to look at is this setup, because it's very important setup for the sentiment of the price. But I want to give somebody an example. Here we can see where the NFP and US data was released. So what happened, ladies and gentlemen? Let's get our pen out. The price increased, quite a big increase. It increased all the way up to here, but then it collapsed. Okay, so what do I want people to keep in mind? Gold corrected on 6 occasions out of the last 9 NFP Friday releases. On 6 occasions out of the last 9. And to be honest, it's really, in my opinion, 7 out of the last 9. But that specific one was kind of 50-50, so I didn't mention it. But it's between 6 to 7 out of the last 9. So as individuals, you should note that there's always going to be a strong possibility that the price will correct. So you have to take it into consideration. So when we're looking to trade, expect the correction, even though there may not be one. If there's not and it continues, of course you can take advantage of it. Otherwise, you should expect a correction, because you yourself, if you go to the charts and check the last CPIs, you will notice a lot of the time, most of the time, there is a correction, even if it's temporary. Same applies for NFP, for example, as well. Same applies for the GDP, especially if it's a less important event. For the CPI and the Fed, the correction may not be as strong straight away, but with other data such as GDP, it can be, for example. Now, the first thing we need to do is establish the longer term support and resistance points. So here I've got on the 2-hour, and I'm looking at the latest support and resistance points. So somebody says, what do you mean? Can you please explain what you mean by the price correcting on the last 6 of the 9 NFP? What do I mean by correcting? So when let's say we get positive NFP data and gold declines like this, it corrects. So it moves in the opposite direction like this. So out of the last 9 NFP releases, so the last 9 months, on 6 occasions, it corrected. So what I'm saying is most of the time it corrects. So you should expect the correction. Looking at for the correction, what time frame should you focus on? The correct, of course, news and correction is short term. So 5 minutes, 4 minutes, 1 minute, 6 minutes, these time frames. But before going there, we need to look at the 2 hour. Why? Because what am I doing? I'm looking at the main support and resistance point. So I've gone to the 2 hour and I know the resistance point is here. Okay, so this is where I am because this is an FP. But I've gone back and I know this is the resistant level. So this is where it collapsed, the most recent time, the strongest resistant level. Then I've gone to the support level. Most recent is here. This is the support level. So if you look at the announcement, we can see increase to here. So it was very close to that resistant level. So you can see the importance here of the resistant level. I can see a question, I'll answer that in a moment. So I've got an individual who says, if we can look at how to enter and exit, we are going to look at how to enter and exit, but it's a process. It's not, 5 minutes, put these indicators, this is where you enter, this is where you exit. That's not going to benefit you. And to be honest with that, you won't have a high success rate with that. The market is not as easy as just having a checklist. If this happens, buy. If this happens, sell. If you do that, there's a much higher level of risk. To be honest as well, with news, all the strategies that we have looked at is something you can take into consideration as well, okay? Because we've looked at a lot of strategies over the past month, but we're going to look at some today as well. But it's a process, okay? You need to look at it overall, not just an indicator buy, an indicator sell. I can guarantee you institutions and professional traders don't look at the market in this way. But either way, the first thing that we need to look at is the support and resistance point, the main support and resistance point. You can see though, it finds here and here support and resistance at this level. Before we go into the chart, you need to be cautious of these levels. The next thing, before you go into the chart, here we have a 75 bar exponential moving average. So 75 bar EMA, exponential moving average. And here, ladies and gentlemen, we actually on NFP were below the 50 on the RSI. Okay, so this is indicating sellers have controlled the market. So as the price increased, I also should have been cautious because the indications is a different type of price movement. Okay, so this is the first thing that we do. Next thing that we're going to do, ladies and gentlemen, and this is going to help the individual, the lady that asked this question about where to enter, where to exit. But please also look at the previous webinars that we looked at, because we were looking at lots of strategies on how to enter and exit. But there is other things you have to take into consideration as well. So what am I doing? I'm looking at the breakout point, but I'm placing, because there's a lot of volatility during the news announcements, I'm placing my breakout points further away. So my breakout point, ladies and gentlemen, is actually here for my bullish breakout, and my breakout point for the bearish breakout is here. Why? Because you can see this is where mainly we're finding resistance, okay? And this, again, you can see is mainly where we're finding support. So this is the breakout. If it breaks above here, upward price movement. If it breaks below here, downward price movement. But because we're trading based on news, ladies and gentlemen, I'm actually placing my breakout level at 0.9% higher. Okay, so this is my breakout level if the price increases, and this is my breakout level when the price decreases. Now, why do I put it further away? Number one, because there's a lot of volatility. Number two, what happens most of the time when somebody trades the breakout, especially if they place pending orders, because a lot of people that trade the breakout with pending orders, is that somebody would have put the breakout level here, so exactly at the breakout, as we were coming closer to the event. So, for example, here, the price entered. But if it was negative, because the event took place here, if it was negative, you would have entered a buy, and then the price would have moved in the opposite direction. Okay, so this is why, because there's volatility, you want to avoid entering before the news is released. I put the breakout level 0.09% away from the current resistance and support level, so the current bullish and bearish breakouts. So here with 0.09% above, and here with 0.09% above as well. Please ignore my handwriting mark because I'm using a computer mouse. Now, based on this, ladies and gentlemen, here all the way upward price movement from this breakout, people may say it's too late, okay, it's too far away. It's not. Based from here all the way up to here, the breakout, okay, the upward price movement after the breakout is 0.45%. Again, more than enough price movement. And again, we're looking for shorter term price movement and a shorter term trade. Why? Because, ladies and gentlemen, there's a correction. A lot of the time, 90% of the time after news, there is a correction. Okay, so you don't want to hold on too long for the trade, because look what happens, guys. This is what happens. It corrects a lot of the time, not always, but a lot of the time. So how can we know we've entered here? We've understood how to enter. We're using the breakout, but 0.09% above. But how do we exit? Now, what we can take into consideration, ladies and gentlemen, is the MACD. Here we've got the MACD bars. Now, when there's been 1, 2, 3 bars lower, then we can consider closing our trade, okay? So when did we close the trade? So we saw a very strong decline here, very strong decline. Some people would have exited straight away. They did, they would have exited here, which case, to be honest, still would have been a profit, to be honest with you, but it would have been a lower profit than where I'm going to show you where to exit. Some people would have kept open for longer, in which case there could have been a break even, there could have been a slight loss. But I'm exiting on this candlestick here, okay? Why? Because you can see one bar here, a lower bar, and a lower bar again on a third occasion. So on the MACD, if you get 3 lower bars completed, not 3 lower bars, 3 lower bars completed on the 5-minute time frame, then you can close the trade. And then, of course, you're avoiding this price movement here, but at the same time, you're allowing some volatility and some time to see if the price is going to do something like this. Because a lot of the time, and we'll see some examples as well, it will just slightly dip and then continue, in which case, ideally, you want to hold on to the trade rather than exiting. Because if it kept on moving upwards and you exited, you'll be saying, Michalis, why did you tell me to exit? This, ladies and gentlemen, you're waiting for an adequate indication before exiting in order to avoid that downward price movement. Of course, if it moves downwards and then starts to increase thereafter, of course, you can still take that next signal into consideration. A great strategy that we looked at for that continuation of the trade, which is mainly for the second impulse wave rather than the first impulse wave. Remember, we said there's less risk when it's the second impulse wave compared to, for example, the first or the fourth or the fifth, is the sentiment cross strategy. So this is example number 1. Example number 2, we're going to give another scenario as well. Here, ladies and gentlemen, again, we had news release. This time we're looking at Bitcoin, and it's a 5-minute time frame. Again, we want breakout levels. So this was the breakout level here, ladies and gentlemen, and I placed my breakout level higher. Now on this scenario, because the volatility levels on Bitcoin is very different to gold, I've not placed it 0.09% above, but I've placed it 0.15% above, so slightly higher above. Why? Because there's more volatility. Positive news, the price increased. As the price increased here, this is where I traded. I kept hold of the trade until I got very clearly 3 bars lower. Okay, now people could have looked at one. So this is the first bar, the second bar, and the third bar. Okay, so bear with me one moment. So this here, ladies and gentlemen, is this actually, we've got 2 bars here which are the same. It's not lower. This is lower. So that's 1, 2, 3, 4. So actually, we would have closed the trade at 2 candlesticks before. So 1, 2, 3. So I've actually would have closed the trade here. So it's even higher, even better. So that's where I would have closed the trade. So after 3 bars lower, after 3 bars is completed lower, not 3 bars lower, 3 completed bars lower. So the candlestick needs to be completed. What's another option that we can do? Another option that we can do as well, ladies and gentlemen, is we can place a 40-bar exponential moving average on the 5 minutes. Okay, so not on another time frame, on the 5 minutes. And if the price declines and hits this 40-bar EMA, then as soon as it hits it, you close the trade. Not drops below it. If it hits it, close it. Okay. So this is another method that you can use as well. Otherwise, you can use, like we used on the previous slide, the breakout, but slightly above the breakout levels, whether it's up or down, it's absolutely fine. And then when it declines for 3 bars, 3 completed bars, which case we would have closed here. That would have been a great close. If we're entering here, guys, and we're exiting here, that's an amazing trade. You've absolutely 100% pinpointed the up and the down as well. Alternatively, you wait for it to hit the moving average. So far, it hasn't hit the moving average, so you're still in the trade and it's still moving upwards. Okay, so this is a great scenario as well. Another thing people can take into consideration, there's a lot of indicators, a lot of methods that say trade the breakout, yes. As soon as it goes overbought, close the trade. To be honest, it will go overbought straight away. So this is the 1 minute chart. If we're going to use our RSI, we're going to go to the 1 minute chart. Even though if you're waiting for it to be overbought on the 5 minutes, on the 10 minutes, it's going to be overbought straight away, especially if it's a very big announcement that creates a lot of volatility. It will be overbought straight away. So you can see here, we're overbought here. So as soon as the news is announced, we're straight away overbought. So what's the point in that? Here we would have traded slightly above the breakout. So you can see this is the breakout. We would have traded 0.09% above. So let's say, for example, somewhere here. Great entry points, of course, a lot of upward price movement. We definitely want to avoid this 100% because we want to, of course, take advantage and, you know, we've earned that much money, okay? We want to protect it as much as possible. So what do? We wait not for the RSI to hit the 75 mark, but we wait for it to drop below. So as soon as there's space between the dotted line and the blue line, so not hit it, but drop below, as soon as there's that much space, then that's the area to trade. So here, for example, this is where there's space between the blue line and the dotted line. So you would have exited the trade here, ladies and gentlemen. Again, very, very high. Another scenario here, this is also where we can see slippage. Why? Because there's a very big gap here. Breakout level. So the breakout level, ladies and gentlemen, is actually here. This is the breakout level. We would have done 0.09% above. On this scenario, it doesn't matter because there was a gap. So it would have actually opened here on the new price. So this is where you would have entered. This is the buy. Okay. This is actually looking at the NASDAQ on the 1 minute chart. We've got some upward price movement, not much though on this scenario, but we did get some upward price movement. Then though, ladies and gentlemen, we wanted to ensure that we close on a profit. So again, I wait for there to be space between the blue line, not that it's dropped and hit it, but that it's dropped below it. Okay, so as soon as it drops below it in the space, we close. So we would have entered here, we would have exited here. So again, that's a profitable trade again. So ladies and gentlemen, we've been speaking now for 1 hour and 10 minutes and 20 minutes. So it's been a long time. There's been a lot of information. We're going to answer the questions. The main thing I want to say, guys, is we've looked already at a lot of strategies over the past month. So I don't want every single webinar to be, you know, this is where you enter, this is where you exit. It's also about understanding the market. Because if you're only looking at a strategy on when to enter and exit, and you look at nothing else, then of course, it's going to be very difficult to be a trader, a successful trader, and not only a successful trader, to be consecutively successful. It's like, for example, there's football players that have a lot of skill, but they cannot read the game. Because of this, they're not great players. Okay, so it's not just about the skill, it's about understanding the way of looking at the market as well. Let's quickly answer these questions. Is it safe to say we should trade after the news? No, we mentioned this. Look at what's being priced within the market. You can trade based on that, okay? And of course, today we look at news trading. So after the news and when the news is actually released. The only thing I will say is when it's just before it's released, it's a very risky, unstable area of the market. So maybe be cautious just before it's released, you know, the 1 hour, 2 hour, 3 hours before. But other than that, you can definitely trade what is being priced in within the market. Which event or pair is on that side on overbought? So this gentleman here is referring to this slide, most likely. So here we've got a pair, the Euro USD. Okay, so if the price increases, it's in favor of the USD because it's the first currency. If the price decreases, it's in favor of the it's in favor of the euro because the euro is the first currency. If it declines, though, the price declines, it's in favor of the US dollar because it's the second currency. So the fact that it's overbought here, it is indicating, ladies and gentlemen, that the euro is overbought because it's the first currency. Let's answer the next questions. Can I have the recording? Yes. It will be sent automatically. Recording, yes. Guess we can use the EMAs too for the exit. Yes, of course you can, especially this 40 bar exponential moving average EMA here is for the exit, okay? But you can use a crossover as well. So this is an upward crossover. When it crossovers downwards like this is where you need to take into consideration an exit. This is something also you can use 100%. We looked at that last week actually. This is an 8-bar exponential moving average, and this here is an 18-bar simple moving average. So the exact same setup as last week, the exact same. 8-bar, 18-bar. But the 8-bar is exponential and the 18-bar is simple. We're going to release the poll as well. Let's actually release the poll and I'll answer the rest of the questions in the meantime, because I'm pretty sure a lot of people want to exit. So will the Dow Jones break its resistance level? The resistance level of 39,472. Will the Dow Jones break this level this week? Will the Dow Jones break this level this week? So will the Dow Jones break the 39,472 resistance level this week? Are pending orders respected during news? Depends what you mean by respected. They're respected. They're in place. It's not being ignored by the market. It's just about, is that price available? Because if there's a gap, like we saw last week, no, you were open. The pending order will open on the new price, or it may not open at all because it was never at that price. Can I get the settings for the 3 EMAs? Yes, of course. So we have the 8-bar EMA. We also have the 18-bar simple moving average, so SMA, and the 40-bar EMA. So 8, 18, 40. So let's end the poll. This is actually very interesting. Okay, very interesting. It's almost 50-50, ladies and gentlemen. So we have here 57% believe it will break this resistance level. 43% say it will not. So 43% say it will increase to that resistance level and break it. 57% say it will increase to that level. 43% say it will not. So, ladies and gentlemen, let's end today's session. Trade safe, trade responsibly, as always. Hopefully you found it educational. Always, like I said, today's webinar, we were looking at other aspects as well, but the strategies that we've looked at over the past month is definitely something you should also look at and take into consideration when trading news as well. So let's end the session. And trade safe, trade responsibly, and hopefully we'll see you very soon on our next webinar. In the meantime, goodbye.